Investing in companies that aren't just struggling, but are, teetering right on the brink. Businesses staring down bankruptcy.
Yeah.
At first glance, it sounds really counterintuitive, maybe even, I don't know, a little unsettling. You might picture those headlines about vulture funds descending on troubled firms.
Right, that's the common image.
But if you peel back that initial reaction, you find this whole world of investing dedicated to a really powerful idea, finding good companies with bad balance sheets.
Exactly.
It's high risk, absolutely, but for those who really understand it, the potential rewards can be massive.
That's the core paradox, isn't it? You're not chasing the high flyers. You're kind of digging through the wreckage looking for hidden value.
Right.
It's a space where financial engineering meets legal strategy and, frankly, operational grit.
Okay.
You need to understand the complex architecture of a company's debt and equity, navigate the, often contentious world of bankruptcy courts, and have a vision for how a broken financial structure can actually be fixed to reveal a viable business underneath.
So this isn't your average stock pick.
Oh, not at all. It's a specialized craft, a very specialized craft.
And that craft is distressed debt investing. Today, we're taking a deep dive into this fascinating and, sometimes intimidating corner of the U.S. market. We've pulled together insights from a whole range of sources. Expert analyses from CAS, foundational definitions from Investopedia, legal perspectives from firms like Chapman and Cutler and Holland and Knight,
strategic thinking from the CFA Institute, mergers and inquisitions,
and even academic rigor on valuation from NYU Stern. Our mission is really to make sense of it all for you. We want to understand exactly what distressed debt is, uncover why investors are drawn to its, let's say, treacherous waters.
Right.
Break down the core strategies they use, figure out how they assess whether a company can actually be saved, and highlight the very real challenges and risks involved.
Yeah, and we'll walk through key concepts like creditor priority and the absolute priority rule in bankruptcy, explore how traditional valuation methods kind of fall short, and what analysts do instead. Look at some real-world stories that illustrate both success and, failure, and even touch on where some distressed opportunities might be emerging in the current market.
It sounds like it demands a blend of financial savvy, legal knowledge, and often operational expertise.
It really does. It's about seeing potential where, almost everyone else only sees failure.
Okay, let's unpack this world then, starting with the basics. What exactly is distressed debt? We use the phrase debt that's in distress, which seems obvious, but the term must have a specific meaning in this market.
It does, yeah. At its heart, distressed debt refers to debt instruments, think corporate bonds or bank loans issued by companies that are in significant trouble.
Significant trouble meaning?
We're talking about companies facing major operational problems like falling sales or rising costs they just can't manage, or more commonly, financial problems. Things like struggling to make interest payments, violating terms or covenants as they're called on their existing loans.
Right, those loan agreements.
Exactly. Or they might already be in default or getting really close to filing for bankruptcy protection.
Okay. And how do you actually spot this distress in the market? Is it obvious?
Well, the most visible sign is usually the price of the debt itself. Because the market is worried the company won't be able to repay the full amount, the debt starts trading at a significant discount to its face value.
They're way below par.
Way below. Instead of a bond with, say, $1,000 face value trading near $1,000, it might drop to $500, $300, or sometimes even much, much lower, trading at cents on the dollar, as the saying is.
Okay.
That deep discount is basically the market pricing in the high risk of non-payment. You'll also see much wider interest rate spreads on this debt compared to healthier companies, reflecting the yield investors' demand for taking on that extra risk.
And these are companies with terrible credit ratings, presumably.
Typically, yes. Their ratings have fallen far below investment grade, often into the CCC category or even lower, which signals a substantial imminent risk of default.
So, cheap debt from a company that's visibly struggling. But the key insight you mentioned earlier, this idea of good company, bad balance sheet. Why is that distinction so vital?
Oh, this is absolutely fundamental. It's really the difference between just speculating and making an informed investment in this space.
Okay.
A distressed debt investor isn't just buying cheap debt from any failing business. They're looking for companies where the underlying business, what it does, its products, its services, its market position, is fundamentally sound and viable.
So the core operation is okay. but the finances are a mess.
Exactly. The distress often stems not from a broken business model, but from a messed up financial structure. Maybe they took on way too much debt in the past, maybe the terms were too rigid to handle temporary market shifts, or they just hit a rough patch that their existing capital structure wasn't built to withstand.
So the potential isn't just a hope the debt price goes up randomly. It's a belief that the underlying business actually has value.
Right.
And that value can be unlocked if the financial problems are fixed somehow.
Precisely. The distressed investor is making a bet that they can either facilitate or capitalize on a restructuring of the company's finances that allows that fundamentally healthy business to thrive again.
And if that happens?
Well, if that happens, the debt they bought at that huge discount can recover significantly in value, or potentially even be converted into valuable equity if they end up taking control of the company through the process.
It sounds incredibly complex and specialized. Who are the typical players in this market? I mean, is this something an individual investor like me could easily get into?
Generally, no. It's really not set up for the average individual investor with a standard brokerage account. This is primarily an institutional game.
Right.
The major players are specialized hedge funds with specific distressed debt mandates, private equity firms that have dedicated distressed investing strategies, sometimes called distressed PE,
Right.
and other kinds of managers focus specifically on these complex credit situations. The term vulture funds is often used, sometimes, with negative connotations.
Yeah, you hear that a lot.
Because they are perceived as profiting from a company's failure.
That's where that public image comes from, isn't it? The idea of investors sort of picking over the bones of a dying company.
It is. And while there might be some mutual funds or maybe more broadly accessible funds that hold some distressed debt as part of a wider credit strategy, directly engaging in the kinds of active strategies we're talking about usually requires significant capital. Big money, deep expertise in both finance and law, and a real tolerance for illiquidity. These things can take a long time to play out. It's a long, long way from just buying shares of Apple or Microsoft.
Okay, so it's a specialized group looking for viable businesses burdened by bad debt. This still sounds incredibly risky, though. Why would anyone choose to play in this space? What's the big upside that justifies diving into these, troubled waters?
The primary motivator, like with much of finance, is the potential for high return.
Right. Money talks.
The entire premise is built on the ability to acquire assets, in this case, debt, at a price significantly below what they are fundamentally worth, or maybe what they could be worth if the situation gets resolved successfully. The distress itself depresses the price, creating that opportunity to buy low.
So the crisis is the opportunity, essentially.
Exactly. And it's not just about buying cheap debt and hoping the price recovers on its own. A significant driver for many distressed investors, particularly those aiming for the more active strategies, is the influence and power that comes with being a major creditor.
Okay. Influence.
Yeah, if you hold a substantial portion of a company's debt, you become a crucial voice at the table during any restructuring or bankruptcy process. This gives you leverage. Leverage to negotiate terms favorable to your position.
Like getting paid back more.
Potentially, yes, or ensuring the restructuring plan benefits your specific debt class. Or it could even mean getting the chance to take control of the company.
Influence control. That adds a whole different dimension beyond just betting on a price increase.
It absolutely does. And the potential for upside, it can be significant. If the company successfully navigates its distress, whether that's through a negotiated out-of-court restructuring or a court-supervised bankruptcy process, the value of the debt you acquired at cents on the dollar can rebound dramatically.
Dividend profits.
Leading to potentially substantial capital gains. And interestingly, these returns can often be uncorrelated with broader market movements like the S&P 500.
Uncorrelated? How so?
Because they depend more on the specific outcome of that company's situation, the restructuring plan, the legal rulings, the operational turnaround, than on general economic trends. So it can offer potential diversification benefits to a larger portfolio.
Diversification benefits in distressed assets.
Huh.
That's an interesting angle. And you mentioned the priority in bankruptcy. That's a big part of the appeal too, right? Debt holders stand ahead of equity holders.
That's a critical element, yes, though it's really vital to understand the nuances here. In bankruptcy, the absolute priority rule generally dictates that debt holders get paid before equity holders.
Right.
Secured creditors, those whose loans are backed by specific assets like real estate or equipment, they're typically first in line, but only for the value of their collateral.
Right.
This provides a theoretical cushion compared to investing in the company's stock, the equity, which is often wiped out entirely in a bankruptcy.
So equity gets zero usually.
Very often, yes. However, it's by no means a guarantee for debt holders either. If there isn't enough value in the company's assets to satisfy all the debt claims, which is common in distress, then even some debt holders, particularly those lower down in the capital structure, can suffer significant losses or get nothing at all.
So priority helps, but it's not foolproof.
Exactly. While priority offers potential protection relative to equity, it's definitely not a risk-free position. Still highly risky.
Understood. So potential for high returns from buying low, gaining influence and control, maybe some portfolio diversification, and relative priority in a downside scenario. Those are some powerful reasons to get involved. But it all seems to hinge on whether that troubled company can actually recover. How do investors figure out if they're looking at a temporary setback or, a terminal decline? This feels like the make or break question.
You've absolutely hit upon what is arguably the most crucial piece of analysis in distressed investing. Getting this wrong is, well, it's a recipe for disaster.
Okay.
It requires distinguishing between what the sources call dislocation and disruption.
Dislocation versus disruption. Okay, let's break that down. What's dislocation?
Dislocation describes distress caused by temporary factors. Think of cyclical downturns in the economy, maybe short-term operational missteps the company made, or transient market shifts that won't last forever.
So temporary problems.
Right. These are problems that are, at their core, manageable and potentially recurrent over time. The business model itself isn't fundamentally broken, it's just facing a difficult period. The company needs to adapt its strategy to navigate the storm, sure, but it doesn't need to fundamentally reinvent itself.
So the business is sound, fundamentally, but it's just hit a patch of very bad weather. Like a temporary storm they need to weather.
That's a good way to think about it. The Ontex case study mentioned in the sources is a great illustration of this. Ontex produces hygienic products like diapers.
Okay.
They faced significant profitability pressure because of a sharp rise in oil prices. Oil is a key input cost for them. But the fundamental demand for diapers didn't just disappear, right? People still needed the product. The business wasn't suddenly obsolete.
The problem was with their input costs spiking, not with people wanting diapers.
Exactly. And crucially, the source points out that a major factor contributing to their earlier distress was a rigid debt structure. It just couldn't handle that kind of temporary volatility and costs.
Ah, the bad balance sheet part.
Precisely. Later, they accessed cov-lite loans with fewer restrictive clauses or covenants, which offered more flexibility to manage those fluctuations. This is classic dislocation. A fundamentally viable business facing a temporary, albeit significant, external shock, made worse by a brittle financial structure. It was a fixable problem requiring financial adaptation, not a complete business model overhaul.
Okay, so dislocation, temporary, fixable, requiring adaptation. What about disruption then? That sounds more permanent, more serious.
Disruption is far more insidious, yeah. It refers to permanent structural shifts in the market or fundamental obsolescence of the company's core business model.
Game over for the old way of doing things.
Pretty much. This isn't a temporary headwind. It's more like a seismic shift that makes the company's current way of operating unsustainable in the long term. Overcoming disruption requires not just adaptation, but often radical reinvention and re-engineering of the entire business. It's a much more difficult, sometimes, frankly, terminal threat.
So, if dislocation is bad weather, disruption is like the climate changing permanently, making their old business model impossible to sustain.
That's a perfect analogy. The EMI Music case study is a stark example of disruption. EMI was a giant in the recorded music industry, built on selling physical media like CDs.
Right, I remember buying EMI CDs.
Their distress in the 2000s was directly caused by the internet revolution, file sharing, online piracy, the shift to digital downloads. This didn't just temporarily impact sales, it fundamentally destroyed the market for their core product.
The entire distribution and consumption model for music just changed forever. Irreversibly.
Right. And despite having what the sources describe as a very flexible capital structure in their private equity buyout, they use those cov-lite loans, payment in kind, or PI interest, where interest gets added to the principal instead of paid in cash.
So trying to conserve cash.
Exactly. And they had equity cures and turnaround plans focusing on cost cuts and finding new revenue streams. But the fundamental disruption was just too powerful. The market for CDs had collapsed by something like 2/5 between 1999 and 2007, and it was accelerating just before the buyout.
Wow.
The source highlights how paying a high multiple for a business facing that kind of terminal decline was inherently flawed, regardless of how flexible the financing was.
So even clever, flexible debt couldn't save a business model that the market had fundamentally rejected.
Yeah.
The core business was broken.
That's the key lesson. And this really brings home the point from the sources about the risks pyramid. You can picture financial risk or leverage as being the tip of the pyramid, but it sits precariously on top of other layers. Operational risk, market risk, and strategic risk at the base. If that base layer, particularly strategic risk stemming from market disruption, is crumbling, then adding more debt, more leverage is incredibly dangerous. It simply puts more weight on an unstable foundation, often leading to collapse, as it did with EMI.
That pyramid image makes it very clear. If the business model itself is broken by disruption, the debt is just going to sink it faster, no matter how clever it is. So, okay, identifying dislocation versus disruption is the absolute first filter. Huge. Once an investor decides, okay, this looks like dislocation, or maybe the disruption is severe, but we think we have a radical plan to manage it, how do they actually put money to work? What are the specific strategies in this space?
Right. There's a whole spectrum of approaches, really. It ranges from simply buying and selling the debt like any other security, all the way to actively taking control of the company and trying to turn it around yourself.
Okay, let's start at the maybe less involved end of that spectrum.
Sure. The most liquid strategy is probably distressed debt trading. This involves buying the debt, usually publicly traded bonds of a distressed company at that deep discount we talked about.
Right.
The investor's goal here isn't necessarily to get involved in fixing the company itself. It's more about trying to profit from a short-term rebound in the debt's price.
Okay, so buy low, sell. Slightly less low, hopefully quickly.
Essentially, yeah. This rebound might happen because maybe the market overreacted to the initial bad news, or perhaps there's a small piece of positive news, or sometimes just general market movements lift all boats, even leaky ones, for a bit.
So you're basically betting on a perceived mispricing and hoping to flip the debt relatively quickly.
Yes, it's primarily a trading strategy based on market movements and perceived value discrepancies. The holding period is typically shorter, and there's minimal, often no, direct involvement in the company's operations or its restructuring process.
Okay, so that's trading. What if you want a bit more influence than that? You want to affect the outcome.
Then you move into what's called active non-control. Here, the investor buys a significant, but not necessarily a controlling stake in one or more types or tranches of the company's debt.
Significant meaning.
Enough to have a voice. The goal is to gain influence at the negotiating table during a restructuring or bankruptcy.
You want a seat at the table, basically, to fight for terms that are favorable to your specific debt position.
Exactly. The ABC carpet example mentioned in the sources, where a firm might build up, say, a 40% position in a key debt tranche, illustrates this perfectly. You aim to negotiate for a better outcome for your specific debt class, hoping its value will rise as a result of those negotiations.
But you don't control the whole process.
No, and that's the challenge. You're relying on negotiating with other creditors who might have very different conflicting interests. This creates what the sources called accidental partners.
Accidental partners. That sounds like it could be a real headache.
It can be. They can complicate or even block your desired outcome. So this strategy involves a longer holding period than simple trading, and definitely higher risk because you're tied to the outcome of that complex restructuring process.
Okay, so what if you don't want accidental partners?
Right.
What if you want to control the outcome yourself?
Right. That leads to the distressed debt control strategy, which is often known as loan to own.
Loan to own. Sounds descriptive.
It is. This is a more aggressive approach where the investor identifies and strategically acquires a controlling position, often over 50% in what's called the company's fulcrum security.
The fulcrum security.
Yeah.
Okay, we need to unpack that term again. You mentioned it earlier. Why is it so important for this loan-to-own strategy?
Okay, remember the absolute priority rule. We discussed that strict hierarchy of who gets paid in bankruptcy.
Yeah, debt before equity, secured before unsecured, roughly.
Right. The fulcrum security is the specific layer in that capital structure, typically a class of debt, though sometimes preferred stock in certain scenarios that is just senior enough that it won't be completely wiped out by losses.
Okay.
But it's junior enough that the company's estimated value is expected to run out before this class gets paid back in full.
So it's right at the point where the value stops.
Exactly. And because it's not expected to be paid in full on its original claim, this is the class that is most likely to receive the new equity in the reorganized company as compensation during a bankruptcy restructuring.
So it's the debt class that's expected to take the loss, effectively, but in return for taking that loss, it gets ownership of the company coming out of bankruptcy.
Precisely. The investor does really deep valuation work to figure out which debt class is likely to be that fulcrum security. Then they go out and buy up a controlling stake in that specific debt.
Got it.
Once they have control of that fulcrum security, they can effectively dictate the terms of the restructuring plan, converting their debt position into the controlling equity stake of the new reorganized company. The ABC carpet example also touched on this, how accumulating maybe a 60% position in that identified fulcrum security could lead to a potential takeover.
And once they own the company, they actually step in and try to fix it.
Yes, absolutely. That's the whole point of loan to own. They often replace existing management, implement significant operational changes, cutting costs, selling off non-core assets, refocusing the business on what works.
So they become the operators.
They do. The goal is to execute a deep turnaround and then exit the investment years later, maybe by selling the revitalized company to another buyer or even taking it public again through an IPO. This requires not just financial and legal expertise, but real operational know-how to actually run and fix a troubled business.
Makes sense.
The ABC carpet case analysis vividly showed the potential range of returns here, a really high internal rate of return, or IRR if the turnaround is successful, or a much, much lower one if it struggles or fails. High risk, high potential reward.
That's a serious commitment, taking the reins of a struggling business like that.
Yeah.
What about a strategy focused purely on the turnaround aspect? Maybe not starting with debt.
Right. That's often just called the turnaround strategy. This is similar to loan to own in its hands-on operational focus, but the investor often acquires a controlling equity stake up front rather than starting with the debt.
So buying the stock, essentially.
Buying the existing equity, yes, or maybe injecting new equity capital. This might happen just before or maybe during an anticipated bankruptcy filing. They're coming in as owners right from the start, taking the most junior position in the capital structure.
So they are directly buying into the potential upside of a recovery, but they're also taking the most risk if things go south.
Exactly. They are heavily involved in the operational restructuring and have to negotiate with all the existing lenders from an ownership perspective. This strategy is generally considered the highest risk because equity is the first to be wiped out in a failure, but it also potentially offers the highest reward as the equity benefits the most from a successful turnaround.
All right, so we've covered trading, influencing from a non-controlled debt position, active non-control, taking control via debt, loan to own, and taking control via equity, turnaround. Are there other types of situations distressed investors might target?
Yeah, there's a broad category often just called special situations or sometimes rescue financing. This is quite wide and flexible. It can involve event-driven investing, like trying to profit from specific corporate events like spin-offs or major asset sales by companies that are distressed but maybe not bankrupt yet. Or, importantly, it can involve acting as a lender of last resort.
A lender of last resort?
Yeah.
You mean providing emergency funding when literally no one else will?
Precisely that. When a company is in deep trouble and traditional banks or the normal credit markets slam the door shut, specialized investors can step in to provide critical capital to keep the lights on or fund a specific project.
But they must demand a high price for that lifeline.
Oh, absolutely. They provide this capital in exchange for very favorable terms, significantly higher interest rates than the market, maybe that payment in kind, PIK, interest feature, where the interest isn't paid in cash but gets added to the principal amount owed.
So the debt balance grows faster.
Right. Or they might receive equity warrants, which give them the right to buy the company's stock later at a predetermined, usually low price if the company recovers.
So they get a premium return or a piece of the potential equity upside for providing capital in a really desperate situation.
That's the trade-off, exactly. They take on immense risk providing capital when everyone else has fled, and they expect to be compensated very well for it, either through high-interest fees or opportunistic gains tied to specific events or equity participation. The sources mentioned current opportunities in real estate conversions as an area where this kind of specialized or rescue financing might be particularly relevant right now, which we can touch on more later.
Okay. All these strategies, particularly the ones involving restructuring and control like loan-to-own, seem deeply intertwined with the legal process of bankruptcy. We've mentioned priority and the absolute priority rule a few times now. Can you elaborate a bit more on the crucial role of the bankruptcy system itself in all this?
Yeah, the U.S. bankruptcy system is absolutely central. It provides the legal framework, the rules of the game that govern what happens when a company simply can't pay its debts. It's essentially the battlefield where these restructuring negotiations and control strategies often play out.
So you have to know the rules of that battlefield.
Understanding it isn't optional for a serious, distressed investor. It's completely foundational.
And the cornerstone, as we keep coming back to, is that creditor priority. Who gets paid first?
Exactly. Outside of a formal bankruptcy filing, priority is primarily defined by contracts who loaned money first, whether loans are secured by specific assets and various complex intercreditor agreements negotiated between different lenders. But inside bankruptcy, the absolute priority rule provides a much more rigid, court-supervised hierarchy for how the company's value is distributed, usually from the bottom up in terms of who gets paid.
Okay, and how does that hierarchy typically line up? Can you walk us through the pecking order?
Sure. In Chapter 11, Bankruptcy, which is the most common type for large corporate restructurings, the order of payment from the company's available value is generally like this. First, you have administrative expenses.
Admin expense.
These are the costs of the bankruptcy process itself, things like fees for the lawyers, accountants, and financial advisors working on the case, plus certain critical claims that arise after the bankruptcy filing, like maybe essential supplier payments needed to keep operating.
So the people running the bankruptcy get paid first. Makes sense, I guess.
You got it. After administrative costs, then come the secured creditors, but, and this is key, only up to the value of the specific collateral backing their loan. If their collateral, say a building, isn't worth as much as the loan they made against it, the remaining unsecured portion of their claim falls much lower in the hierarchy.
Okay, so their security only protects them up to the collateral's value.
Exactly. Then below the secured claims, you might have junior lien creditors, like holders of second or third mortgages on assets, if any. Below them are the general unsecured creditors. This is a big category. Think in trade creditors, suppliers who haven't been paid, maybe some bondholders whose debt isn't secured, employees for certain unpaid wages.
Okay.
Then sometimes you have subordinated creditors, who explicitly agreed in their loan documents to be paid after other specified creditors. And finally, right at the very bottom of the pile.
Let me guess. Shareholders.
Equity holders. Shareholders. They only receive any value if everyone above them in that entire stack is paid back 100% in full.
Which almost never happens in a real distress situation, right?
Very, very rarely. Usually the value runs out long before it gets to the equity holders, meaning they get wiped out.
So the value gets distributed layer by layer from top to bottom, and the minute the company's estimated value runs out, everyone below that point gets nothing, or maybe pennies on the dollar.
That's the cold, hard reality of the absolute priority rule in practice. And this is why understanding and identifying that fulcrum security is so absolutely vital to strategies like loan-to-own.
Because it's the class right at that tipping point.
Exactly. It's the class of debt that is expected to be at the precise point where the value distribution stops. It absorbs the loss because there isn't enough value to pay its full claim, but crucially, because it's high enough in the structure not to be completely wiped out like the layers below it, it receives the new equity created as part of the reorganized company structure going forward.
It's the pivot point, the place where the debt claim essentially turns into ownership of the new company.
Precisely. Identifying that pivot point requires a really sophisticated valuation thesis for the distressed company. You need to estimate what the company's going concern value is likely to be after restructuring, or maybe just its liquidation value if it's being sold off, to see where that value level sits relative to all the different layers of debt in the capital structure.
Valuation in distress situations. That sounds like another major challenge. I mean, how do you...
They are indeed. Very difficult. Standard valuation techniques like, say, discounted cash flow, DCF analysis, they're built on assumptions of a going concern, the idea that the business will continue operating, maybe even growing for the foreseeable future.
Which might not be true at all here.
Exactly. For a distressed company, that core assumption is highly questionable. Their future cash flows are incredibly uncertain, possibly negative, and the possibility of complete failure, meaning a sudden end to all cash flows, is very real.
And comparing them to healthy companies using valuation multiples would also be misleading, right? Because they aren't facing the same level of risk.
Totally misleading. As the NYU Stern source points out, you can't just plug numbers from a distressed company into a standard valuation model built for healthy ones. You have to adapt significantly and be very conservative.
So how do distressed investors adjust their valuation approach then? What do they focus on instead?
Well, they put a huge emphasis on downside protection. A critical first step for many, maybe the first step, is performing a liquidation value analysis.
Liquidation value.
Yeah, you have to estimate what the company's assets would likely be worth if they had to be sold off quickly in a fire sale scenario. What could you realistically get for the pieces? This provides a potential floor value. A key rule, maybe the key rule in this space is know your downside.
Know your downside. Okay.
If the price you're considering paying for the debt or the assets isn't at or ideally below that estimated liquidation value, your risk of losing a significant portion or even all of your investment is enormous.
So always start by figuring out the absolute worst case scenario value.
Yes. Then other methods are used, but they are always heavily adjusted. You might look at trading multiples of other companies in the same sector, even healthier ones, but you'd apply a massive discount to reflect the distress. Transaction comparisons, looking at what similar distressed assets have sold for, can be helpful, especially in markets like real estate where comps are common. Sum of parts valuation can work if the company has distinct divisions. Maybe some are healthier than others. You value them separately. And you can do a modified DCF, but you have to make really aggressive, pessimistic adjustments to the cash flow projections and use much higher discount rates to account for the high probability of distress or outright failure.
Quantifying that probability of distress must be incredibly complex itself.
It is. It's more art than science sometimes. The NYU Stern material mentions using tools like looking at the company's bond ratings. S&P and Moody's publish historical default rates associated with different ratings. You can also analyze the bond prices themselves. Lower prices generally imply higher perceived risk by the market. Or you can use more complex statistical models like probit analysis to estimate default probability based on financial ratios.
Wow.
You can also sometimes view the equity in a highly distressed company almost like a long shot out of the money call option. It only really has significant value if a successful turnaround, which might be an improbable event, actually occurs.
It sounds like you need expertise not just in general finance, but also deep knowledge of the specific industry the distressed company operates in.
Oh, absolutely essential. Valuation approaches can be very, very sector-specific. In energy, for instance, valuing an oil and gas company's debt often involves digging into petroleum engineers' reserve reports.
Reserve reports.
Yeah, these estimate how much recoverable oil and gas is likely in the ground and what it might cost to get it out. Different reserve categories like 1P proven, 2P proven plus probable, 3P proven plus probable plus possible have different probabilities associated with them and are discounted accordingly in the valuation.
Okay, very specific.
Or in renewable energy, like valuing a wind or solar farm project, you often use probabilistic modeling, looking at P50, P75, P90 scenarios based on long-term historical weather data to estimate future energy production and thus the value of the assets or the cash flows they're likely to generate.
That level of specific industry knowledge, alongside the financial and legal expertise, it really underscores just how specialized this field is. And it brings us squarely to the significant risks and challenges involved. It's clearly not just about normal market risk, is it?
Oh, far from it. The risks in distressed investing are multifaceted and can be quite severe, frankly. One of the most fundamental is simply the illiquidity risk.
Illiquidity, hard to sell.
Very hard sometimes. When a company is in distress, it can be incredibly difficult to sell its debt or assets quickly without taking a huge loss, a big haircut. There just might not be many buyers at a reasonable price. And despite all the analysis, the risk of losing a substantial amount or even your entire principal investment is always very real.
You could literally go to zero, lose everything.
Yes, absolutely. Another major challenge, particularly if you're maybe trying to quietly build a position in debt trading in the market without showing your hand, is the lack of information. Publicly available data might be outdated, incomplete, or just not tell the whole story. This makes thorough due diligence really difficult and can leave you with an incomplete picture of the company's true problems and prospects.
So you might be making decisions somewhat in the dark, to some extent.
Often, yes, or at least in dim light. And you're almost never alone in these situations. There's often intense competition from other distressed investors who spotted the same opportunity. And as we discussed, those accident partners, other creditors holding different layers of debt with different priorities and goals can significantly complicate negotiations or even actively block your strategy.
Right, the competing interests at the table.
Exactly. And the legal system itself, while providing the framework, must also introduce its own significant set of risks. Well, it introduces enormous risks. The bankruptcy process itself is complex, can be lengthy, and is often quite unpredictable. You face significant legal and execution risk.
Like what specifically?
Well, for example, there could be lender liability claims brought against debt you've acquired, maybe alleging the previous lender did something improper that harmed the company. There could be hidden collateral defects, where the assets you thought secured your debt turn out not to be valid collateral for some complex legal reason. Unexpected statutory lay-ins, like government tax claims or environmental cleanup costs, can suddenly pop up and potentially jump ahead of your debt in the priority queue.
Ouch.
Borrowers or other lenders might engage in aggressive liability management tactics, trying to restructure debt or move assets around in a way that specifically disadvantages your position before a bankruptcy filing. And even the bankruptcy courts themselves can sometimes limit your credit bid rights in certain situations, which affects your ability to acquire assets using the face value of the debt you hold instead of cash.
So even if your financial analysis is perfect, a legal curveball could completely wipe you out or derail your strategy.
It's a constant threat, absolutely. And even if you successfully navigate bankruptcy, restructure a company, maybe take control, there's still no guarantee of long-term success. The company could easily face future distress down the line if the market changes again or the turnaround doesn't stick.
Right.
And finally, there's always regulatory, political, and reputational risk. Certain aggressive strategies, or simply being labeled a vulture fund in the media, can attract unwanted negative attention from regulators, politicians, or the public.
Wow. That's a truly daunting list of things that can go wrong. Given all those potential pitfalls, what is absolutely essential for investors trying to manage these risks?
Deep, meticulous due diligence is paramount, absolutely critical, and it goes far, far beyond just crunching the financial statements.
What else does it involve?
You need to investigate the quality and track record of the management team. You need to understand any potential or pending litigation against the company. Are there hidden environmental liabilities? How exposed is the business to volatile factors like commodity prices or foreign exchange rates? And as one source really stresses, you must understand your counterparties.
The other players.
Yes. Who holds the other significant debt tranches? What are their likely goals? What pressures are they under from their own investors? What are their personalities like at the negotiating table? Knowing who else is involved and what motivates them is absolutely critical to navigating the process successfully.
It sounds like a full spectrum, almost intelligence gathering analysis.
It really is. And perhaps most importantly, know your limits. Distressed investing requires highly specialized expertise across finance, law, and often operations. You absolutely need experienced advisors. Don't try to navigate the legal maze of bankruptcy court or analyze incredibly complex capital structures alone unless you are truly an expert yourself. You need to fully understand the mechanics of the legal process and what your rights and obligations actually are in a worst-case scenario.
So expertise is totally non-negotiable. It's a field where you absolutely need to be a specialist or partner with specialists. Don't try this at home, basically.
That's a very good way to put it.
Okay, we've covered the what, the why, the how, and the many risks. Let's maybe circle back now to some real-world examples and look at where opportunities might be emerging in the current environment.
Sure. We touched briefly on the classic lessons from Ontex and EMI earlier. Ontex illustrating how a fundamentally good business suffering from dislocation can be saved if the financial structure is fixed.
Right, the good company, bad balance sheet case.
It's exactly. Versus EMI, which showed how a fundamentally broken business model suffering from disruption is incredibly hard to save, even with all the financial flexibility in the world.
The bad company, flexible balance sheet case, almost.
Kind of, yeah. Those are powerful modern examples of that core dislocation versus disruption framework.
What about some slightly older historical examples that maybe highlight some of the strategies we discussed?
Well, the sources mention Martin Whitman's work back in the late 70s and early 80s with a company called Anglo Energy. He apparently acquired debt in this struggling oil service company, used that position to gain control, took it through bankruptcy, and converted his debt into equity to take ownership.
A classic successful loan-to-own strategy resulting in a turnaround.
Exactly. A very hands-on approach going from debt holder to equity owner and operator.
Interesting. Any others?
And another notable case mentioned is the involvement of the Franklin Mutual Funds in the big Canary Wharf property development turnaround in London back in the 1990s, after the original developer went bust.
Right. That was a huge failure initially.
Huge. The banks ended up owning this massive half-built project. Franklin and some other savvy investors apparently bought the discounted debt from the banks, who just wanted out. This allowed them to participate in the eventual restructuring and the revival of the project as the London property market recovered later.
So that sounds more like a distressed asset purchase, buying the bad loans from the banks.
Exactly. Buying the debt from lenders who were stuck and just wanted to cut their losses rather than directly engaging with the company initially.
Learning from history is definitely key. What about today, right now? Are there particular areas where distressed opportunities seem to be cropping up more frequently?
Well, the current market landscape seems to present several potential areas, yeah. The sources discuss the lingering effects of what they call the Great Glut of capital.
The Great Glut.
Yeah, following the global financial crisis and then the massive pandemic stimulus. This period saw incredibly easy money flow into companies, which led to over-leveraging in some traditional industries and maybe inflated valuations for a lot of startups in the tech space.
Right. Cheap money chasing deals.
Exactly. And while private markets tend to adjust valuations more slowly than public ones, imbalances definitely exist. Plus, the recent regional bank collapses in the U.S. also have potential implications. They might reduce access to things like bridge financing for startups or smaller companies.
Meaning
Short-term loans to tide them over. If that dries up, it could push more firms into distress, maybe faster than they otherwise would have fallen.
Okay, so tightening credit conditions and the hangover from past excesses could be creating potential pain points and thus opportunities.
Precisely. But one particularly highlighted area right now, which seems potentially ripe with opportunity for distressed investors, is U.S. commercial real estate, especially offices.
Yes. We hear a lot about the trouble in commercial real estate.
The market is facing a real confluence of negative factors. You've got rising interest rates making refinancing much more expensive. You have the lasting impact of remote and hybrid work significantly reducing demand for office space. And you have a large volume of pre-pandemic leases that are set to expire soon, forcing potentially difficult renegotiations or just outright vacancies for landlords.
Especially older office buildings, I imagine. They must be less appealing now to companies rethinking their space needs.
Exactly. The material notes that older office space, Class B and C buildings in particular, faces a really high risk of mortgage default. This is especially true as tenants downsize or move to newer, higher quality buildings, the so-called flight to quality. This leaves the landlords of these older buildings with insufficient rental income to service their debt.
And this debt is often held by banks or packaged into complex financial instruments like commercial mortgage-backed securities, CMBS.
Right. So when these loans default, the lenders, whether it's a bank or the trustee for a CMBS pool, have a problem property on their hands. They may foreclose and try to sell the property quickly, often at distressed prices just to get it off their books. Or they might be willing to sell the defaulted mortgage loan itself at a significant discount. This is where distressed real estate investors step in.
Okay, so one strategy is for an investor to try and buy the physical building itself at a foreclosure auction, hoping it's cheap because the bank just wants out.
Yes. Acquiring the underperforming asset directly from the lender, whose primary focus is usually recovering their capital, not necessarily maximizing profit from the property's potential long-term upside. Buying at foreclosure can offer significant cost savings compared to trying to buy it in a standard market transaction.
Or alternatively, they could buy the defaulted loan itself from the bank.
That's another very common strategy, yeah. You buy the mortgage debt, usually at a steep discount to its face value. As the new mortgage holder, you then have several options. You could initiate foreclosure yourself, maybe negotiate a deed in lieu of foreclosure with the borrower to take ownership without a lengthy court process, use your debt position to credit bid, and acquire the property in a bankruptcy sale process without needing new cash up to the value of your debt claim.
So you're using the debt like currency.
Exactly. Or you could just hold the debt, hoping for some kind of restructuring or eventual recovery in the property's value. The goal often is to acquire the underlying property at a favorable low-cost basis and then either turn it around, maybe renovate it, reposition it, or just hold it and sell it later for a profit when the market improves.
And this is where that rescue financing comes into play for real estate as well, providing lifelines.
Absolutely. Distressed real estate owners who maybe can't access traditional financing to fix up their buildings, cover operating shortfalls, or manage upcoming lease expirations might seek out rescue financing. Specialized debt investors can provide this capital, but again, in exchange for those very favorable terms we discussed earlier, high interest rates, PIK features, maybe an equity participation kicker.
The desperate borrower gives this sophisticated lender a lot of leverage in that negotiation.
Significant leverage, yes. And a particularly compelling trend within this whole real estate distress picture, highlighted in the sources, is the opportunity emerging in commercial office to residential conversion.
Adaptive reuse.
Turning
Empty or underused office buildings into apartments.
Exactly. It addresses two major converging trends you see in many urban areas right now. First, a severe shortage of both affordable and market-rate housing. And second, a growing surplus of vacant commercial office space, particularly those older buildings less suited to modern work styles. Work from home really accelerated the decline in office demand, leaving large amounts of this space empty as leases roll off.
So you have these declining assets, the empty offices, meeting a huge area of high demand, which is housing.
Precisely. Adaptive reuse projects take these underperforming, sometimes obsolete assets and repurpose them into high-demand ones, often centrally located apartments or maybe mixed-use spaces with ground-floor retail. And critically, the sources mention that converting existing buildings can actually be significantly more cost-effective than constructing brand-new multifamily housing from the ground up, potentially saving as much as 40% per unit in some cases.
Wow, that's a huge cost advantage right there. It sounds like a perfect example of finding value by solving a problem created by major market shifts.
It really is. It's taken a declining asset class and transforming it into a booming one. And often the whole process is facilitated by acquiring the initial building at a distressed price or providing the necessary rescue financing for the conversion.
Makes sense.
And if you look even further out, broader demographic shifts, things like falling birth rates and plateauing life expectancy that were discussed in one source, could create longer-term structural shifts in demand for certain goods or services, potentially causing distress in completely different sectors down the line, much like rising oil prices affected ONTEX years ago. These big macro trends aren't just temporary blips. They can create fertile ground for distressed opportunities over years and decades.
So the distressed investing landscape is constantly evolving, isn't it? Influenced by everything from technology shifts and global health crises to demographics and, of course, interest rates. It demands a truly wide-angle view of the world.
It's really about seeing how fundamental shifts create cracks in the market, create problems for some companies, and then knowing how to find value within those cracks.
Okay, let's try and bring it all together then. After this deep dive, what are the absolute key takeaways for someone trying to grasp the essence of distressed debt investing in the U.S. market?
Okay, key takeaways. First and foremost, it is definitely not for the faint of heart. This is a high-risk, potentially high-reward area, but it requires significant capital, a high tolerance for risk and illiquidity, and really deep expertise.
It's a specialty for a very good reason.
Absolutely. Second, probably the single most crucial piece of analysis is correctly identifying the nature of the distress. Is it dislocation, a temporary fixable problem in a fundamentally sound business? Or is it disruption, a permanent, potentially terminal threat to the business model itself? Get that wrong, and your investment is likely doomed from the start.
Dislocation versus disruption.
Yeah.
That's the core filter. Got it.
Third, understanding the capital structure and the legal framework of bankruptcy is completely non-negotiable. Your position in the priority stack, identifying that all-important fulcrum security, and knowing how to navigate the legal process, these dictate how any investment strategy will actually play out. And the specific strategy you choose, whether it's trading, active non-control, loan-to-own, or turnaround, needs to be chosen carefully based on your analysis and your desired level of involvement and risk.
Structure, strategy, and the law. That's the essential toolkit.
Fourth, always know your downside. Start your analysis with the liquidation value. What are the assets worth in a fire sale? If your potential purchase price isn't comfortably supported by that worst-case fire sale value, you're taking on immense, maybe uncompensated risk.
Know your downside before you even think about the upside.
Exactly. Fifth, due diligence must be deep and comprehensive. Look way beyond the financials. Look at the operations, the management team, potential legal pitfalls, hidden liabilities, and crucially, understand the motivations and likely positions of your counterparties, the other players at the negotiating table.
Dig deep, look wide, understand the whole picture, including the other people involved.
And finally, as we stressed a couple of times, seek expertise. You need legal specialists, financial specialists, and often operational specialists by your side. This isn't a space for going it alone based on surface-level information or gut feelings.
Excellent summary of what is clearly a complex but potentially very rewarding field. So to wrap up this deep dive into U.S. distressed debt investing, we've really explored a specialized world that's focused on finding value where most people only see failure. It demands this unique blend of financial analysis, legal acumen, and strategic thinking. It offers significant potential returns for those who are properly equipped to navigate its considerable complexities and risks, particularly by correctly identifying the root cause of the distress, that dislocation versus disruption piece, and always understanding their potential downside.
It's definitely a game played in the shadows of corporate failure, but for those who can master it, problems can indeed be turned into profitable opportunities.
And that leaves us with maybe this final thought for you to consider. In a world that seems increasingly characterized by rapid change and unexpected shocks, from technological upheaval and pandemics to geopolitical shifts and fundamental demographic changes, are we perhaps entering an era where distress isn't just a rare event affecting a few unlucky companies, but maybe a more persistent, even recurring feature of the broader economic landscape?
Interesting question.
And if so, does that create a kind of continuous cycle of opportunities for those investors who are prepared to abandon the usual pursuit of smooth upward trajectories and instead find value by navigating the inevitable turbulence and, looking for those gems hidden in the rubble? Something worth thinking about as you look at the market today.